I think in terms of conventional semantics, we aren't yet in a recession. We are in an economy that is working well for people like me, people with access to subsidized credit and people with the knowledge to use that credit. It is not a society that is working well for people who sell their sweat. It is also an economy where I think we are beginning to cannibalize, to a fairly substantial extent, the capital available for people your age in favor of people my age. People my age voted themselves all kinds of cool benefits and forgot to pay for them. And I think the chickens are coming home to roost around that. I need to say that through most of my career, I've been a bit pessimistic about the economy. I joke that between Doug Casey and I, we have accurately forecast 17 of the last 3 recessions. And so I don't listen to myself as much anymore. But I do also need to say that I'm concerned about the fact that the economy that we are in has been propped up by government spending and by very cheap subsidized credit for a long time. In my experience, I'm tempted to say that there needs to be a reckoning. That reckoning may very well be in the form of a recession or a depression. I also need to say, however, that by training, I'm a credit analyst, not an economist. And my track record on economic forecasting is, like all other forecasters, lousy. I'm old enough to remember the decade of the 1970s, when we had the same sort of circumstance in front of us. It's important to note that at the beginning of the decade of the 1970s, the on-balance sheet liabilities of the U.S. government were less than 20% of GDP. Now the on-balance sheet liabilities of the U.S. government exceed 115% of GDP. What that means is there's less capacity to deal with it. But let's look at the numbers, which are truly enormous. As you suggest, the on-balance sheet liabilities of the U.S. government, represented by U.S. Treasuries, are about $35 trillion, or $29 trillion net of the Fed's own balance sheet. The scarier number is the net present value of the off-balance sheet liabilities of the government, which is to say entitlements, Medicare, Medicaid, Social Security, federal pensions, military pensions, that sort of thing. The Congressional Budget Office, not some cranky old libertarian named Rick Rule, but the Congressional Budget Office estimates that those numbers currently exceed $100 trillion. It would seem for both parties in the United States that continued spending is sacrosanct. If you can't contain government spending, the only way out of funding these twin deficits that I can see is by printing. People say it isn't a problem, first of all, because we owe the money to ourselves. Wrong. The spenders owe it to the savers in terms of the on-balance sheet liabilities. But the off-balance sheet liabilities at $100 trillion are simply actuarially unsound. In the U.S., when Social Security was instituted, it was designed to start at age 65, when the average life expectancy of an American male was 66. In other words, society took on for men a 1-year liability, for women a 6-year liability. Now it starts as young as 62. There's a disability feature, and the life expectancies are much, much greater at the same time that the population of old people, beneficiaries, dwarfs the population of young people, contributors. This is really an intergenerational transfer of wealth from your generation to my generation. The truth is that it cannot actuarially continue. I think that really the only way out will be to print. They say, as an example in my country, well, tax the billionaires. The total net worth of American billionaires is $5.6 trillion. If you stole all of their money, every bit of it, you would fund the operating deficit, which is to say the on-balance sheet liability deficit, for 2 years. You wouldn't make a debt in principle, and you wouldn't do anything at all for Medicaid, Medicare, Social Security, federal pensions, and military pensions. This is a spending problem, not a revenue problem. And I think it's going to be a very, very, very large political problem. And I think the outlook as a consequence of that arithmetic for the U.S. dollar and every other fiat currency on the planet is pretty dire. Not an immediate problem, not a 2024 problem, not a 2025 problem. But as I recall the decade of the 1970s, we solved the problem by reducing the purchasing power of the U.S. dollar by 85% over the decade. In other words, we inflated away the net present value of those obligations. And the only way that I, as a credit analyst, see our doing that, which is to say reducing the economic impact of that deficit and maintaining nominally our promises, would be to do the same thing. Reduce the purchasing power of the dollar and hence reduce the net impact of those promises on society. Times have never been better. Prosperity is here for Rick Rule, who has access to credit and the knowledge of how to use that credit on assets that generate income in excess of the cost of capital. This is the finest time in human history. There's nothing like it. For the people in Argentina very recently who had the foresight and the courage to cut government expenditures by 50% and cut regulation, prosperity is coming back in leaps and bounds. For people who live in heavily indebted societies, for people who have believed the government lies around their entitlement to government benefits and haven't developed the skill sets to participate in this economy, I don't think that prosperity will ever return. Invest in their education. Come to understand that the expectation of entitlement on the backs of others is fraud, and that they need individually to develop the skill sets that will allow them to generate enough utility for other people that it exceeds the utility that they consume for themselves. That's the only way out. There's a young man who occasionally does some work for me around here, 23 years of age, and he bought himself a power washer. And with this power washer, he is able to make himself $150,000 a year. He, at 23 years of age, with his fiance, owns a home. And they are saving to buy a second revenue property. Well, he generates $150,000 a year in gross sales. His fiancée generates another $65,000 or $75,000 in gross income, and their gross consumption between the two of them is $60,000, which is to say they're generating $200,000 pre-tax with high school educations while spending $60,000 and putting the rest in income generating or at least cost avoiding real estate. For them, prosperity is here. I think a cut is coming. I think a cut is irresponsible, but I think a cut is coming. The lower level employees at the Federal Reserve, at least the ones I'm in contact with, believe that the Federal Reserve is the only institution that is in the way of the rapid deterioration of the U.S. dollar, which is what a cut would do. Remember that the measure of inflation that they use is the Consumer Price Index, the CPI. The U.S. federal government would have you believe, as an example, that health insurance costs have declined by 21% over the last year. I don't know anyone who got a rebate. And importantly, in both the U.S. and Canada, and I hate to make this so statistical, the CPI doesn't include tax. The largest component of a household expense, a working household expense in the United States and Canada, is tax. It's the cost of government. And the idea that a cost of living index doesn't include the cost of tax is farcical. It's completely farcical. For middle-income families in the United States and Canada, the cost of government exceeds the cost of shelter, exceeds the cost of health care, exceeds the cost of energy, and exceeds the cost of fuel combined. And it's not in the index. So when people look at inflation statistics, I would ask them to look behind the numbers. And I would ask them to think about the deterioration in the purchasing power of U.S. and Canadian dollars relative to the basket of goods and services that they consume, and not pay so much attention to the CPI, which I now refer to as the CPI. There is still a lot of confidence in the market, and there is still a lot of liquidity in the market. There's a lot of cash in the market. As you know, I'm occasionally concerned that there will be some event, a so-called black swan, that none of us have interpreted, and that will cause a crisis in confidence and a liquidity squeeze. We aren't seeing that. I think, by the way, parenthetically, that the disintermediation in high-yield debt funds is highly intelligent. I think that we have underemphasized credit quality in a search for yield. And I think what you may be seeing is at least smart households returning to some sense of sanity. The biggest black swan out there that scares me is the trillions of dollars in high-yield ETFs, where the top structure, the ETF itself, is highly liquid, but the assets that they hold, junk bonds, often over-the-counter bonds, are highly illiquid. If you have a circumstance where nervousness about credit quality comes down to the retail investor and they begin to liquidate the ETFs, and the ETF managers are forced to liquidate junk bonds into very illiquid markets, you have a run on the bank that almost can't be contained. There was a saying in junk bond markets in the 70s when they were very skinny that many of these bonds were, David, quote, owl bonds. An owl bond is where you call your broker and say sell, and your broker says, to who? To who? And that's my real terror. My real terror is that concern about credit quality becomes commonplace, and you have a disconnect between people coming out of the liquid ETFs and the manager's ability to sell the underlying assets. So I'm delighted to see people beginning to come out of those high yield ETFs now. If they did it gradually and ratably over time, we could perhaps sidestep my biggest single concern about the market. What I hope people are doing is putting it in shorter term obligations, maybe U.S. 10-year treasuries accepting 4.4 with effectively no credit risk other than the deterioration of the purchasing power of the dollar, relative to 7 in assets that I think are highly susceptible to default. Hopefully, people are taking shorter duration, taking less yield, and improving the credit quality of their savings. I don't know that that's what's happening, but I hope for their sake that's what's happening.